Hi everyone, thank you for tuning to RHB Bank's mid-year market outlook for 2023. Today we have a few noticeable speakers joining us. Dr. Salish Jad, Group Chief Economist and Head of Financial Market Research, will be covering on the global market outlook. Tan Jitun, CIO of RHB Asset Management Singapore, will share his thoughts on emerging market outlook. Finally, Muhammad Fauzi, CIO for Equity, and Michael Chang, CIO for Fixed Income, both for RHB Asset Management Malaysia, will be covering Malaysia equity and fixed income respectively. Hi, Dr. Salish, how are you?
I'm very good. Thank you for having me.
Dr. Salish, Nasdaq has up by almost 30% on the year-to-date basis, while S&P 500 has also a double-digit rebound in the same period. How do you perceive the performance and potential growth of the US equity market in the second half of 2023?
So our S&P 500 end-of-year target is 4,800. So that's around 10% upside from current level. We continue to remain also positive on the Nasdaq, and broadly speaking, we have been positive on the U.S. equity market overweight position since December 15, 2022. The three key catalysts are that even though we have a Fed funds rate peak forecast of 5.5 to 5.75%, balance of risk assessment that it could go to 5.75 to 6%, this rate, around 5 to 6% Fed funds rate, was already priced in last year in the fourth quarter. Many people haven't recognized that, and that's what partially led to the bear market in the U.S. equities last year. So it's all fully priced. Second is that our GDP growth forecast is 2% for this year versus market forecast of 1.2%. Market been looking at 0.4%. Back in the day in December when we published a 2% number for GDP for 2023. The U.S. stock market reflects the U.S. economy. So if you're bullish on U.S. growth, you have to be bullish on the U.S. Stock markets. And thirdly, we think that given that most investors, at least in terms of real money accounts, hedge funds, global accounts of this nature, have missed this big rally in equities because global investors mostly, on average, have been overweight bonds, market rate cash, underweight equities. We've been overweight equities, market rate fixed income, underweight cash. So they've simply missed the boat. And what will happen is they will be scrambling to meet their benchmark returns. And basically, it's a positioning move that money will flow in from these big investors who have simply missed the boat. These are three cabinets for a positive view on U.S. equity market for the year.
Those Salish, with the US VIX index at 5-year low and the US interest rate paused by now, some invest that there could be interest rate cut by end of the year or early next year. So would you think that the interest rate cut will be the main catalyst for the risk-on market environment going forward? Additionally, do you identify any other factors that may contribute to this positive trend throughout the year?
So I don't think interest rate cuts are what the market is looking at. What the market had been looking at in terms of rates was, already happened in the fourth quarter of last year, where the market had already, basically a peak Fed funds rate of 5 to 6%. And that's what caused the bear market in U.S. equities last year. Our view is that there is a risk that the Fed may need to go to peak Fed funds rate of 5.75 to 6%. Not our base case. Base case is 5.5 to 5.75%. We always stress the system. And the bottom line is that's not going to drive a meaningful decline in U.S. equity market. So we took it out one box. What won't cause the decline, which is interest rate going higher. What will cause it to go, lower, sorry. What will cause it to go higher? There are two main factors. One is that, the markets are pricing in no recession, right? As far as the U.S. and global growth goes. We're of that persuasion in terms of U.S. equity market pricing, where we think U.S. GDP will end up this year on average at 2% versus 2.1% last year. And that we will see a recovery in the summertime in U.S. and global growth. Market is looking for continued slowdown in terms of some markets, not the equity market, mind you. Fixed income is looking for slowdown. And we don't think that's going to happen, right? So the Bloomberg consensus forecast is 1.2% after having initially estimated around 0.4% or so in December of last year. So the U.S. stock markets reflect the U.S. economy. So if you're bullish on growth like we are, the U.S. stock market has to go up. The third main factor is that most global large investors, such as real money accounts, plain English, long-term investors and hedge funds, had been overweight bonds, market weight cash, and underweight equities. That call has gone wrong. We've been overweight equities, market weight fixed income, underweight cash. What that means is most global investors are coming from behind to meet the benchmark returns or essentially risk that their job is not going to be there anymore. Okay? So they're going to have to chase this market, and that market chasing from a positioning perspective will give that tailwind to U.S. equity markets for the better part of this year. One example, we like the S&P Financials Index. That's basically just the U.S. banks. We like them. We've been long the U.S. banks since April, in fact. That trade's working nicely, and we have an S&P 500 target by year-end 4,800, which is around 10% upside from current levels.
Okay, talking about the US equity market, we can't avoid from talking about the technology sector. So what's your view about the impact of artificial intelligence, ChatGPT-alike technologies within the technology sector? So do you think that there is more drive in the technology sector on the upward trajectory? Meanwhile, is it too expensive to go for the technology underlying stocks now? Should investors wait longer before they enter to the market?
So it's very geographic focused. I would say if you are willing to take more risk via the technology sector, that has to be in the United States from our perspective. And the reason is that the geopolitical pressures, from the Western Alliance on China and other emerging markets is going on China specifically, and rest of EM trades with China. So our bearish call on China has worked quite nicely. We've been bearish on China, including tech, because of the geopolitical risk involved. So bottom line is the valuations don't look a bit stretched, and so that will cause some near-term correction risk. But these, from our perspective, over the next 6 to 12 month horizon, will be providing you opportunities to buy those good tech names. I can't talk about individual names, but basically from a tech perspective, is likely to be quite good in terms of total returns.
Okay, thank you very much for sharing today, Dr. Sai. Moving on to the emerging market, Jitut, the Chinese equity market has recently experienced downward trend, giving up all its profit, if any, for the year, despite the highly anticipated China reopening story. How would you comment on this situation?
Okay, so the recent downtrend in the Chinese stock market can be attributable to a few factors. I think one would be the US debt ceiling. I think that has caused equity markets in general to be quite weak throughout the world. And in addition, specifically to China, I think there are also a variety of drivers that has been worrying the market. The possibility of a second wave of COVID in March and April of this year caused some concern to the market as well. The other thing is also in terms of the measured tone from the political bureau in April, also signal to the market that there will not be a big bang type of stimulus. And also, we also saw the US-China tension ratcheting up a few notch over the course of the last few weeks. And I guess last but not least, I think the recent data coming out from China has shown to the market that certain quarters of the markets have been overly optimistic in terms of how fast and how aggressive the China market will reopen post the end of zero COVID situation. So all these drivers in totality actually helped to actually pushed down the market somewhat over the course of the last few months. However, I also want to highlight that there are positive drivers that should drive the market higher in the foreseeable future. Like, for example, the PMI data has shown a very, very strong inflection point after December of 2022. We have seen manufacturing PMI data as well as non-manufacturing PMI data rising quite nicely as well over the course of the last few months. So obviously the non-manufacturing data or the service PMI have been much stronger than the manufacturing PMI. I think that is understandable considering the fact that the developed market in general has been quite weak over the course of the last few months. And also, I just want to highlight that in terms of the retail sales and industrial output data, I think the data has been very, very strong over the course of the last few months as well. Retail data has shown to be roughly in the region of mid-teens to roughly about 20%, whereas for industrial output data, I think has been around 5% thereabouts. And last but not least, I just want to highlight that the China GDP for 2023 will be around 5%. And if you compare that versus the GDP of other developed markets, I think China's GDP of 5% will prove to be quite credible compared to the rest of the world.
There are upcoming monetary policy expectations from the Chinese government, and do you believe that they will be sufficient to reverse the negative sentiment in the equity market, or will they be simply help to alleviate the market pessimism?
Over the course of the last few months, we have seen definitely drastic changes in terms of how the Chinese government has modified the monetary policy in China. I think we have seen RRR or the reserve requirement ratios being cut a few times over the course of the last 18 months or so. And also, more importantly, we have seen policy benchmark cut in June of 2023. I think that signaled to us the strong intentions of the Chinese central government in terms of trying to stimulate and try to support the economy. However, more importantly, right, apart from the various monetary policy changes that we have seen over the course of the last few months, I think more importantly, we should also focus on the other macro policy changes that have taken place over the course of the last few months. Like, for example, in terms of the property sector, we have seen the government pushing out property support programs over the course of the last few months. We have seen loosening of the very, very tight property measures from November of 2022 onwards. And in fact, within the last few weeks, we have seen supportive measures coming out from the central government in order to support the overall property market in general. And also, we have seen stimulus measures to support the electric vehicle or the EV sector over the course of the last few weeks as well. So I guess what I'm trying to say is that not only should we look at the monetary policy, which is obviously in a loosening stance, we should also take note of the other broader policies that the central government in China has been pushing in order to support and stimulate the economy.
Well, the global space technology sector had done really well for the year. Chinese and also Asia-Pacific technology sector also demonstrated the significant rebound. So besides tech sectors, is there any other sectors that you are considering to include in your investment portfolio?
Yes, Nova. So the technology companies that are directly linked to the artificial intelligence or the AI team has indeed done very, very well, right? Be it in the US, in Asia, and in fact globally as well. However, I also want to point out other key positive themes that are also driving the market higher. I guess I just want to point out that the big Chinese internet company have also done well over the course of the last few months. I think it's quite clear that we have come to the end of the very, very stringent regulatory scrutiny and the regulatory crackdown that we saw over the course of the last 2 years. And in fact, that has changed into support for this big Chinese internet platform. And the other drivers that we are very positive on would include the electric vehicle or the EV sector. I think this sector is well supported by government policies, and we have seen also tax incentives coming in over the course of the last few weeks in order to support the overall sector. And the other few key themes that we are playing for our portfolio would include the travel sector. I think the travel sector has yet to hit the last high that we saw pre-COVID, and we think that there is significant scope for improvement over the course of the next few quarters. But last but not least, I also want to highlight that in China, I think the SOE reform or the state-owned enterprise reform is also gathering steam. Our view is that over the course of the next few quarters, we should see significant efforts on the part of SOE in terms of improving and transforming their overall business strategy as well as their overall profitability. So these are some of the key themes that we are playing for our portfolios over the course of the next few quarters.
Dear investors, if you have any questions for Dr. Sailesh or Jitun, please put down in the comment box below. We will address your inquiries as soon as possible. Finally, moving on to Malaysia equity and fixed income space. Encik Muhammad Fauzi, considering the state election and political uncertainties, what strategies does the fund manager have in place to invest in sectors that are relatively insulated from these political uncertainties?
Thank you, Nova. In our view, the stock market will never like uncertainties. We would expect that the sentiment of the stock market to be weak and every sector would be affected due to the uncertainties. The uncertainties are not only due to the election, but there are others at the moment, like fear of US economy going into hard landing as a result of the aggressive rate hikes, slower than expected economic recovery in China, slowing Malaysia economy, and also weak ringgit. Hence, we would expect the market to remain volatile with downside bias. Our approach will be more stock-specific rather than sectors. As shown in the chart, FBM KSCI index is among the best in the region that offers good dividends to investors. We avoid politically linked companies and focus on companies with good dividend yields and strong free cash flow. We believe the defensive sector will do well under current high interest rate environment and market uncertainties.
As a portfolio manager, are you inclined to increase exposure to Bursa's small cap stock?
Right. From the chart, we can see the small cap stocks perform better than the big cap stocks year to date, as represented by the FBM small cap index. It is interesting to note that within the small cap space, there is huge difference in terms of performance between the small cap stocks and the micro cap stocks year to date, represented by FBM fledgling index. However, there was a big swing in terms of performance for the small cap index after it returned around 9.8% from 1st January 2023 to 3rd February 2023. The index was down 8% compared with the FBM KFCI index of minus 6.8%. To us, corporate earnings growth is important to fundamentally justify stocks. From our monitoring, FBM small cap earnings estimate has come down by 4.5% year to date, whilst FBM KSCI earnings estimate is up by 1% year to date. On the other hand, the FBM small cap index performed relatively better than the FBM KSCI index. Hence, from earnings perspective, the big cap stocks have better earnings growth as compared with the small cap stocks. But yet, the small cap stocks perform better than the big cap stocks. The main reason could be attributed to the foreign selling who holds many of the big cap stocks. Year to date, foreign institutional net sold 2.84 billion of Malaysian equities. There have been persistent selling Malaysia equities in 2023, primarily in our opinion due to weak ringgit. We don't totally rule out investment in the small cap stocks, as the investment could possibly give the alpha to the portfolio due to the lack of foreign participations. However, the volatility is huge and 1 minute to limit the exposure in the small cap stocks.
Michael, with the possibility of global interest rate nearing to its end, between local and global fixed income, which do you believe will offer higher total return to our investors?
Right. Thanks for the question, Nova. So essentially, I think both local and global fixed income have their merits, and the capacity to rally in a decent positive trajectory is there simply because end 2021 and end 2022 has been extremely bearish for the fixed income market, not just Malaysia, but also globally. This was also mainly due to the unprecedented hikes of interest rates from the US to fight towards inflation. And this has also led other global central banks to also coherently hike rates aggressively because of what US has also done. So on that basis, I think overall US has actually hiked 500 basis points or 5% to its benchmark interest rates in less than 18 months. Malaysia has also hiked its interest rate, but of course on a more or a more gradual basis because over the past 1.5 years, Malaysia has only hiked about 1.25% of 100 or 125 basis points. So it has been less aggressive in terms of rate hiking in Malaysia, and also because the inflation expectations for both countries such as US and Malaysia were also different. So to your question, whether there's a possibility of local bonds or global bonds to rally, I think that's definitely there in the next 12 months because we are coming to the peak of the interest rate cycle. And for the positioning of fixed income, it's actually quite clear that it should actually give some positive returns in the next 12 months compared to what we have endured in the past in 2022. Because 2022 was indeed a very difficult year for fixed income. And that's also more across all asset class in 2022, which was unprecedented on that. So just to add a little bit on the perspective of the currency as well, even that you've seen how ringgit has been versus the dollar, I think if you are a dollar investor that has invested in Malaysian ringgit bonds, especially MGS or Malaysian government securities, you should actually have a much higher return of roughly around more than 5% on a hedge basis for this, because that's actually value on a positioning if you add with the FX hedge into the portfolio return. Yeah.
So my last question goes to you. So in the Malaysia investor, there is a significant concern regarding to the AT1 bond in Malaysia following the credit default of a Credit Suisse. Can you provide some insight to enlighten our investors on this matter?
Sure. I think the question of AT1 is definitely very relevant given what has happened to Credit Suisse, and it does cast some fear to investors, especially in the fixed income market, because this was actually a surprise and unprecedented also because no one has actually seen a default of a bank of an AT1 of such a scale and size. So while there are concerns on the AT1, which is actually granted in light of the credit default of Credit Suisse, we do not see any impact to Malaysian bank AT1s. So far, by far, it's also the more solid ones thus far. I mean, in terms of why I say solid is the resilient in prices. There hasn't been a significant dip in terms of prices, even with the AT1 Credit Suisse default. So overall, I think for the ringgit bond market, for AT1s especially, it's kind of muted in terms of impact. We've actually seen the recent AT1s issued by Affin Bank, where it continued to surprise market with decent bids, where the demand was 650 million versus the issuance size of 500 million. I mean, it's covered in terms of the issuance. We anticipate similar demand for issuances such as Affin Bank, for example, Affin Islamic Bank, which is slated to tap the market in the third quarter of this year, either in September or October latest by this year as well. So we foresee liquidity in the domestic bond market to continue to support AT1 offers, because I think generally the investments, generally investors are still looking for yield and income, especially this year when the situation on the economic growth may take a little bit of a hit because of hikes of interest rates, generally slowdown of global growth. So I think what is also important is the Malaysian banking system. In terms of the common equity tier 1 capital in Malaysia, it currently stands at 14.3% versus regulatory limit of 4.5%, provide buffers to most investors. Investors like us will actually be comforted given the common high equity tier 1 capital that Malaysian banks currently have as well. So it's actually close to 3 times the buffers that it's above the regulatory limit. Not just Malaysia, there's also an issuance in the global side where we saw Mitsubishi UFJ Financial Group has also issued a $4 billion, including yen 192 billion and 138 billion of non-core 5 and non-core 10 respectively. This tap is one of Japan's biggest issuance of AT1s for this year, and this is also has taken place after the Credit Suisse default on the AT1s. So just to give you a flavor that there was a knee-jerk reaction when Credit Suisse defaulted on their AT1s, but subsequently I think most of the prices, even in the dollar space, has also adjusted to where it was. It wasn't a significant drop from because of Credit Suisse. So I just want to add also a recent, central banker BNM Governor Tan Sri Nur Samsia was also quick to reply on the state of AT1s issued by banks in Malaysia, and this was actually mentioned on the 29th of March 2023, where they had mentioned that in terms of the requirements of AT1s in Malaysia, it will still be ahead of equity holders. So that does give a lot of comfort to investors because they still see it as important to have this clarification so that we are clear on where the credit hierarchy is, and also against the equity holders such as stock investors. Yeah. Maybe just to add also, I think the government has also added that the components of capital for most Malaysian banks comprises of more than 80% from equities and retained earnings, and not so much reliant on AT1s as their funding in terms of bank funding. Yeah. Hope that answers the question.
Thank you, Michael, for his input on the fixed income space. That actually concludes our mid-year market outlook. Dear investors, we are at the important turning point of US Fed rate pause. Some analysts even predicted that the rate cut could happen as soon as this year, despite here in RHB Bank, we do not expect to see any rate cut until next year. Nevertheless, it's important to re-look into your portfolio and rebalance accordingly. As the saying goes, when the fact change, I change my mind. Please engage your relationship manager and our investment specialist to do your quarterly portfolio review. Thank you very much for joining us today.